All right, the market finished the week on a very high note. In fact, the S&P 500 getting its first all-time closing high in about 4 months. That's a very, very good sign for the markets. The question is, it's been 4 months, and that's a telling indicator actually when it's only been 4 months since our last all-time high. And by the time we get to new, especially when we dropped nearly 20% in between. So I'm going to break down kind of what our expectations are for the markets next week, what our expectations are going forward through the rest of the month of July, and then after that, based off of what we just saw in the indicators. Now, again, this video is available right now for everyone to view. Normally, these full versions of the market outlook are available only for our foundation level members. So join us for just $29 a month, or the $299 a year if you do. You get 2 months for free if you do the yearly version. That gives you access to these videos throughout the week. Other than just the 5-minute previews that I normally post on YouTube. So thank you for watching today. I hope you enjoy this video and you come back for more, and let's go ahead and get started. Today is Friday, June the 27th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. You can see the notification bar at the top of our site. That allows you to see our Market Outlook blog post every day. I'll show you that here in a second. Follow us on Twitter for more content between the videos at DavidSettle42. And again, join our Facebook group that we've created for these videos as well. And you're currently watching a preview, a free Friday preview for the Market Outlook. This is where we host the Market Outlook every day. You can see it under Market Outlook and Video Archives here at the top of our site. If you scroll down, you can see a table of contents of everything we talk about. A lot of content here. So if you have just a few minutes, you want to get caught up on what the market did today, you can go through. I put some charts on there, a few little things that stand out, tips that stand out. You can also see the video will be posted here. Even if it's the 5-minute preview that we do on YouTube every day. Of course, our foundation members get access to this, and you can join our basic subscription to get this blog, to be able to see this blog post by clicking up here at the top, or just going to our basic plan. That will get you access to the blog. The foundation tier gets access to these videos on a daily basis going forward. Again, if you subscribe monthly, it works out to like less than $1.40 per video. If you subscribe yearly, you get 2 months for free. So it works out to being less than $1.20 per video. So if you think the Market Outlook videos are worth, $1.20 or more, then, this is a pretty good value for you, not including the Market Outlook live video, which is where we take a look at old Market Outlook trades we've done in previous videos, and we review them on a day-by-day basis, and we put on that day's trade before the market closes during the live video as well. And again, you can get access to that with your foundation access and get to it here under Market Outlook. Let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators. You can see 4 out of 5 days to the upside this week, really only one down day, and that was literally the smallest down day in the history of the S&P 500, because it goes out like so many decimal points before you actually hit a number. It's a non-zero. So, again, very, very small, very good week, very, very good week here. Really breaking out, coming off of options expiration in a very positive way, getting a cluster this week. Near-term line is well above, the 80th percentile, still actually above the 90th, just barely, but above the 90th. The intermediate line has gone from being, dropping to now rising back up to very strong levels above the 96th percentile. Market sentiment is rising, inching its way closer towards the upper reversal zone as well. So very good pattern here. The momentum line was down early this week on that historically down day. But bounced back up to the upside as we came pretty close to a pretty decent range today. So back up, it's not up in bullish territory, but at least it's above the 50th percentile, and down here at the bottom, we're back above the 2.5% mark, above the 30-day moving average. There at 3%. That's a good. You want to hang around the 2.5% mark when you're bullish, right? That's the idea. You want to pull back during near-term declines and then get right back up to it. That's the goal. That's the goal of any kind of bullish trend. And that's kind of what we had here. We've been hovering around the 2.5% mark, a little bit above it during this grind higher. And then we pulled back down. We didn't get below it. We didn't even get a bull tag. Didn't even get light pink shading, much less a bull tag, because you have to have the combination of light pink shading, which is the intermediate line falling below the 80th percentile, but still above the 50th percentile. And then the yellow line comes from closing below a rising moving average. So you have to have that combination. And we didn't have either one of those during this near-term decline where the near-term line dropped into bearish territory and dipped its toe in oversold levels, but dropped to a bearish territory and then bounced back up. So nice, good move. All-time highs today, all-time closing highs, all-time intraday highs. At first time, no, so yesterday was, no, today. This was the first time, yeah, 61.44 yesterday at 61.41, today at 61.73. So first all-time high since the last one, which was February 19th, and we started to decline on the 20th. So good day, a good day all aboard. If you take a look at the NASDAQ 100, you can see again, same idea, new all-time highs, but we already had been getting all-time highs on the NASDAQ earlier this week. So in fact, we got it on the cluster move that we have here. But new all-time highs, strong intermediate posture, strong near-term run, market sentiment rising to strong bullish levels. I mean, it's bullish all across the board on the market forecast here. If you take a look at the Dow Jones Industrial Average, it also gained 4 times out of 5 this week, but is not close to its all-time high. So that's the difference. But the intermediate line is still strongly bullish. Not quite above the 90th percentile yet, but it's up there. The near-term line also is not quite above the 90th percentile, but it's pretty close. Momentum line jumping up, just like the S&P and the NASDAQ. And market sentiment is rising. Not quite as close to the 80th percentile, but it's getting there. So it looks very similar. It actually did get a bull tag. And we bounced up the new highs, and we're getting close. It's just not quite there. Remember, this is a price weighted average, so it's not market cap weighted towards the Mag 7 names like the S&P and the NASDAQ, especially the NASDAQ 100. The Russell, which is is a much better reflection of a broader scale of U.S. economic activity beyond the Mag 7 names, it's really lagging. So it kind of goes to show again what's really driving this market. It's way below its all-time high. It's not even close. Remember, it started the correction earlier, much earlier than the S&P and the NASDAQ did. And it's been rebounding, but not nearly to the extent. It got light pink shading, did not get a bull tag. It's bounced up, but hasn't bounced up that much above the pre near-term pullback highs. The intermediate line's up, the near-term line's up. Again, not as high as the S&P. The momentum line was a lot lower, so it did jump up above 50, and your market sentiment's again rising. But still, it's bullish. It just doesn't look as bullish as the S&P and the NASDAQ. And again, I tweeted out over the weekend here that, like the market's as concentrated as it's ever been. And it will continue to be as concentrated as it's ever been because, you have really good runs right now in the Microsoft and NVIDIA. In fact, when you look here at the S&P 500 and the weightings of the S&P 500, you can see again, you're looking at what 13.6% right there, and then you add on, about another 5.5%. So for Apple, so you're looking at almost 19% between the top 3 companies, and again 13.5%, over 13.5% from the top 2. That's not the highest that those have been, but it is when you go to the top 10 here, and you'd have to actually include because you have 2 different stocks here from Google. You have to include the idea that you have to add those 2 up in terms of their weighting. And then you also have Berkshire, which is not necessarily a Mag 7 name, but it's the top 10. So you have to go out to the top 11 to get to the top 10 companies. And when you do that, the top 10 companies here are at 36.6%. So actually, it's top 11, sorry. 38%, and that was the tweet I shared out. That's a record. Also, keep in mind too that the CAPE ratio is almost back to 38 now. The highest it's been, on the beginning of a month. So this only looks at the first of the month here, but you can see the highest that we got to, but at the end of last year was about this level, and then in right before the 2022 correction, where we did actually get a correction that brought us down here to the high 20s. See, we didn't even get to the high 20s on this correction that we had this year. We got the 32. But before that correction, 2022, we were up to the 38s. So, like, again, the CAPE ratio is as high as it's been post-financial crisis, post-tech bubble, right? Because at the tech bubble, it got up into the 40s briefly. But this is the highest. I mean, we're just inches off of the highest level. And like I said, the top 10 companies at 38% is the highest mark that we've seen for the top 10. And then, like, I think their earnings make up like 30% of the S&P's earnings, which is also a high watermark, far beyond where we were at the tech bubble when another period of time, at least recently. Markets always get concentrated. That's what bull markets do. They concentrate because winners win. And they in a market cap weighted environment, the highest weightings, stocks keep going up the most because they are weighted the most. And that's just how it works, barring, again, some kind of collapse or something. And you see a little bit of relative weakness in Apple. But, that's just kind of how it works. Well, the Russell's is not participating in that. And that's kind of why it's been such an underperformer, and, unable to really get up to new highs. But also shows why, we focus on the areas that we do focus on while the markets are bullish, because they're the ones, you can see, like, since this April 9th low, technology has just been killing it. If I look at XLK, it's way past its highs. Well, I guess not way past, but it's like the NASDAQ had already gotten new highs earlier in the week, even though it was down a smidgen here. And you can see the near-term line and the momentum line down just a little bit. So let's take a look at how the week ended on the week. Let's go back to the market forecast since it is a Friday and take a look at the weekly market forecast. And you can see the intermediate line had crossed market sentiment. It's up into the reversal zone. It's up now near the 90th percentile. We've been on a bullish run for quite a while. It looked like we were kind of ending it last week, closing out of the bullish territory, rebounding in a big way because, again, intermediate confirmation signal. So we've rebounded. And remember, that's the combination of a strong bullish posture with an oversold momentum line. We rebounded in a big way, and that's a nice, good candle. Kind of looks like this kind of a candle, where you're getting up, you had a pullback. Now this isn't, it's about the same time frame, just not the same depth to the downside. But you had a pullback, you started to stall at the old highs, and then you broke out right there. And you kind of did that here too. You got up to the old highs and stalled over there from 2021, 2022, and you had a really good week here to break you out on January 15th and on December 11th. So just to kind of give you an idea of what that looks like here, let me go to the daily price moves, and we'll go out to the weekly version of this. And again, this was in December 11th of 23. So that's over here. So that would be not this week, because that's when it started, right? That's when we came off of the pullback. But then we got back up to those highs at December the 11th, right there. We started to stall, and then boom, we got a 2% move. And it wasn't, it was nice. It wasn't a huge blowout move. And then again, we started to stall for that January 15th time frame, which is right here. Right there, January 15th of 2024, we also had a pretty decent run to bounce up. This was way better than those two, right here at 3.5% gain for the week. So it looks very similar to those two, but a much better week, breaking up to new highs after stalling for multiple weeks at those new highs. This is what it looks like on the Hakinyashi candle. There we go. Again, a nice little high point there, a nice long upper shadow. Again, we closed at 60.68. We're trading at 61.73, so we're over 100 points above the Hakinashi close, which is about right here. So that means that the open next week will be right around this area. The midpoint of the body is next week's open. So we're going to have a pretty decent sized body next week right off the bat. Again, assuming no huge opening gap to the downside, which is doubtful because that doesn't happen very often. Again, just to kind of give you an idea of how often we gap. This is a weekly chart. I mean, there's been some times we've gapped down on Mondays here recently, but again, not as common, generally speaking. There's actually quite a few downside weekly gaps here, and some of them 0.5% up to 1% to the downside. But that's been during a bearish period of time, and when you're in a bullish period of time, the gaps, if they are to the downside, are very small. And that's kind of more normal than what we would expect here. So we wouldn't expect a big downside move on Monday morning. When you look at the 3 green arrow charts, obviously we have 3 green arrows still looking very good. Above average volume in the last 2 days, which is a good sign for breaking through old highs. You kind of want that. Here's the weekly 3 green arrow. Obviously we have 3 green arrows and back to a green line. Above average volume on the weekly basis. Strong MACD and stochastics. That histogram is about as high as it's been. This is on a MACD, though it's not normalized. If you look at the PPO version of this, it is normalized. Breaking above the value area of the 1-year chart, so you got a lot of volume below us now. The MACD is up. It's already up almost to 1%, but it's above its moving average. So it's not going to go up, a whole lot more. We're not looking for a huge move right now here. But if you look at the weekly version of this, again, the 8 and 17 week moving averages are just starting to cross the 30. That's a very positive sign for the markets. As you can see, the weekly PPO is still, the histogram is pretty high, but it's not, it's high. It's about as high as what we've seen before, at least in these 2022 peaks. The MACD, though, is not very high. Like this is, we are hardly overextended on a weekly basis at all. When I look at the DMI, you can see a nice trend above 30 on the positive indicator, well below 20 on the negative. Just so your ADX is rising is exactly what you want to see. On a weekly basis, we still haven't got the bullish crossover yet, and the ADX is actually still falling below 25. It'll be light pink shading next, kind of like this. But that's kind of what it looks like when we're starting to turn things around from being bearish to being bullish. Over here is kind of the same way. We were bullish, we went a little bearish, we turned back around. So we don't get the dark pink shading very often on the weekly chart. We typically only get it during corrections, right? Correction in 2011, correction 2010, correction in the beginning of 08. That's the only time it ever gets dark pink on this, is when you actually have corrections. And again, when you get those corrections, you go from dark pink to light pink to bullish, dark pink to light pink we only had light pink for a week, and then back to bullish, dark pink to we went to light green right off the bat to being bullish. So that's kind of again, and then there's no shading for a long time, and that's kind of where we're at right now, is the period where we'll probably get no shading for a while, but at least we get the bullish crossover of the positive indicator crossing up above the negative, and we might be a week away from that happening next week. That happening here. Let's take a look at some of the other oscillators, the RSI and the CCI. Very bullish, above 70 for the first time. Let's see, we got the 69.96 here. We got over here to 60. We did get the 70.05 here on December the 4th. And of course, back in last July, around the holiday, we were up very strongly bullish. So it's the first time, for a while that we've been above 70 on the CCI, RSI, and we've been strongly bullish on the CCI. And the weekly looks really, this is the first time we've crossed above 60 on the weekly CC or RSI for a while. We've crossed above 100 already pretty easily on the weekly CCI. That's why it's green down there. So very bullish patterns from that perspective. The Ichimoku cloud looks great, well above 5 on the positive, well above above 80 down here on the trend noise balance, way above the cloud, way above these midpoints. Rate of change clearly positive there. Here's the weekly version. Again, positive rate of change now on a 26 week which is 6 months, right? So positive change has been negative for quite a while, but now that's what happens with corrections. But it's positive now. And we are now on an intermediate strength trend. You can see you get a mature bullish trend. So over here you had an intermediate strength trend and it faltered going into the 2023. That's what we kind of want to avoid this go around. Same time frame, right? The end of July. But once you get going on a mature trend, you can be mature for months. For months. This is the kind of pattern we want to see. Right now, we're not close, but at least we are now flipped from a weak bullish trend developing to now an intermediate strength trend. That's a very good sign, too, from that perspective. And you can also see the cloud has turned green again after being briefly pink, which is what happens during corrections on a weekly chart. Now we're green again. All right, we'll take a look at the Bollinger Bands. We are above the band. In fact, we've been above the band 3 out of the 5 days this week, and above the Keltner channel the last 2. So very good breakout. The bands themselves have broken out above the Keltner channel, and you have some increasing momentum. So right during a time, remember, we are increasing our momentum right now during the time where the S&P is generally bullish. Right, like this period of time. I know we're in the sell in May and go away, but the reality is from pre-July 4th through the post expiration beginning of the earnings cycle, this is a pretty good stage for the market. This is generally a very good stage. In fact, one of the strongest bullish moves over a short amount of time. So we're heading into a very traditionally, seasonally bullish time of year, and we're doing it with breakout signals across all these different indicators. Very good from that perspective. Again, how much longer we'll go, who knows, because we're already up. We're already up. Nope, sorry, not that chart, the zigzag chart. We're already up 19.67% without a 5% decline, but we've gone 27 before. We've gone 38 before. So it's not like we haven't gone, into the 20s. It's just not very common to go into the 20s. It's more common to go into the teens and, the high teens at most, which we're already there. So that's going to be a little bit of a limiting factor unless we can, kind of really take off here. Ryan Dietrich posted out that when you don't get a new high after 4 months, between 4 and 12 months, when you don't get a new high between 4 and 12 months, on the S&P 500, then you do get one, and that's the case now. The 1 to 3 month returns tend to be on average negative. Now he didn't include 2023 for some reason, because we didn't have new all-time highs there, because that's why he didn't do that in 2023. So when you go from an all-time high to 4 to 12 months without one, and then you get one, again, it has to be within that range. Anything more than 12 months like this. Over here was way more than those 2 years, and 1 year returns were great. 1 to 3 month returns were great. So it has to be a smaller time frame, being between 4 and 12, and your 3 month returns on average are 5% declines. So I don't expect us to go up huge, but I do. It is nice that we're finishing the week with such breakout signals here. If I take a look at the intraday move, obviously a new 4-week high point today. We've really pushed the range. That's good because the low is coming up, and by next week the low will be really up. It'll be up pretty close to last week's low. So we've really pushed the range, and that's been nice. It's gotten back above 5%. The rune indicator, we're nowhere near a downside reversal anytime soon based off of this one. Indicator. Obviously, I showed you the volume was above average. The trading range, again, including, one more thing too about the intraday. And here's the other thing too, like we did fill in this morning's gap, and we talked about that in my portfolio management class early in the morning, that, again, it's a common gap, and we ended up filling it in the afternoon before bouncing late. But remember, this is a common gap too, and this is a common gap. So we talked about in our portfolio management class the likelihood that next week we probably fill in these gaps. That's a couple % decline. It would not produce 3 red arrows. It would not produce light pink shading or even a bull tag on the market forecast. It would not produce a red tag because that it has to be 5%. So it would seem like dreadful, but the reality is it would be kind of very normal to fill in these gaps if remember, because it's if we fill in those gaps. But if that happens, a point of control is at the bottom of the gap. It would be no concern at all. In fact, it'd be a very good near-term run, and it would be a very good buying opportunity for any kind of near-term rally, we would have to extend the current intermediate rally after that. So if that happens Monday, Tuesday, Wednesday, which is likely, then don't fret, just use it, right? Use it to find some good opportunities there. Finally, if we take a look at the VIX, you can see the VIX closed the week low, not at its lowest, but close to its lowest, way below 20. The ratio to the 3-month VIX, way below, inside of risk on territory, risk appetite territory, at its lowest levels here. But that's an extreme low. And you see the VVIX actually rallied today. So remember, the 90 level on the VVIX and the 85% level on the ratio to the VIX to VIX3M have been extreme lows for the past year. They've led to rallies. So if the VVIX starts to move up, which it already has, can't get below 90, which is the trending level, and makes its way back to 100, and this correlation dips even just below 75% early next week, then we know we're probably getting a short bout of volatility. But I wouldn't expect, again, we're heading into the most bullish time of the year seasonally. So if we do get any bout of volatility, it'll just be a short-term move and nothing more than that. All right, now let's take a look at the intermarket relationships here, and we'll take a look at our asset class comparison chart, looking at the big performance in the Qs. Gold has been dropping, has had a drop. First, let's look at today, and then we'll zoom out to the week that was. You can see today, eventually here. All right, here we go. So you can see developed markets finished the day up. Stocks were up. Again, they were up really high early, but then pulled back late. The S&P was actually negative for a brief period of time in the afternoon before rebounding into the close. But developed markets outperforming. On the other hand, emerging markets not doing very well. A little bit of strength in the dollar late, pressured emerging markets. Gold really declining because remember, it's been such a big winner for so long. It's hard to maintain. Parabolic moves. If you take a look at what gold has been on for a good chunk of this year, I mean, it's so parabolic, and now it's a little bit of an ascending triangle, but you can see it's breaking down here. I think there's probably a chance that gold does continue to break down. You can see it's breaking down below the 30-day moving average. If I look at it here on the on its moving averages, give it a second here. You can see it's breaking the 50, the 30, and the 50. Let's try that again. There we go. So it's flipping on me. I don't know why it's changing, but you can see it broke multiple moving averages. The 8s crossed below the 17. They're working their way below the 30. So I think gold is making a run towards, the 200, like at least towards the top of the value area at 3,000, if not closer to the moving average, depending upon where it ends up being. That might be a reflection of eventually a strengthening dollar. The dollar's been so bearish, and it finished the week at the lows, but again, it's so extremely low that you wonder, again, how much longer it has to maintain this weakness here. And you saw that there today. Developed markets have been so strong this year, all year long. It's been 52-week highs for a very, very long time. It's had a little bit of a decline to the 50-day here going into options expiration, but a nice rebound, not quite up to new highs yet, but remember, it's already been a lot stronger than the S&P and the US, and the MACD is rebounding back above zero, back above its moving average. Stochastics getting back to the midpoint of the chart. So you see a lot of good patterns here. Commodities, here's another reason why emerging markets didn't do so well today. Not just because of the strength in the dollar, but commodities continue to really struggle, and you see the weakness there. Still holding moving averages, but again, it's kind of like a dead cat bounce. We had such a big drop, and now we're below significant resistance. We were above the point of control and looking really, but we were so parabolic. We talked about that going into options expiration last week, about it's hard to maintain parabolic moves, and you saw that this week. And nobody knew it was going to drop that much that fast, but still, it's hard to make, especially when we all knew how temporary the reason was for the parabolic move in crude oil. So obviously here's the decline, and the question is, will we bounce off this moving average because our economy is strong and economic expectations are strong, and you need commodities to fuel economic expansion? Or are we going to break, according to the technical pattern, this is kind of a bearish technical pattern. You have a big drop, you kind of stall a little bit, dead cat bounce, and then you break through to new lows. If we're testing these lows here by the end of July, that's gonna be a sign that economic expectations are not very strong. Now it also means inflation's not going to be very high, but again, it also means economic expectations are not very strong. The 10-year yield's a big factor as well. We know that. The 10-year yield breaking below, it raised up on Friday, but it broke below the 200-day moving average this week. The moving averages are down. We're flirting with the low end of the 4.5. So it's the same thing. Commodities and yields both break below, significant lows or retest significant lows. That's not necessarily a sign of confidence in the economy. It's more of a sign of concern about economic growth expectations there. And again, that would lead to the Fed cutting rates. And that's kind of really, the tail is wagging the dog, so to speak. It seems like the market is working its way towards kind of forcing the Fed to cut rates. And that's what happened in 2019, right? When the 10-year yield dropped well past the Fed funds rate, and the Fed had to drop the rates, not because they were concerned about unemployment or inflation, but they had to cut rates because the 10-year yield was you had an inverted yield curve you had a rising yield curve, yield spread, but for the wrong reasons. It was because the 10-year yield was dropping well beyond the Fed funds rate. And so you have, the odds of a rate cut in July are still around 80%. That's still, that's going to get to 100. The Fed's not going to cut rates in July this next month. But in September, the odds of a rate cut are 92%. In fact, there's a 16% chance that we'd have a second cut in September. That's the odds, of starting in July. Very unlikely we start in July, right? So even though the odds, are 20% here, the reality is September says it's even lower than that. But still, there's an 8% chance. Some of that comes from this 8% chance that they're not going to cut rates. But that's a low, that's the market is pretty much guaranteeing a cut in September, starting in September. Now, whether that's a long extended run of cuts or 2019, 2024 style cuts where, let's get rid of this so we don't have this in the way. We're at 3.75%. That's a drop. Remember, this tells us the path of rate cuts. We're currently at 4.25, 4.5. So the market is pretty clearly pricing in the path going forward. And the 3-month, it's still flat. It's still right at the midpoint of the current range. So it's basically saying we're not doing it in July, right? Until that starts to break down to the midpoint of the 4 to 4.25 range, that's pretty much saying we're not doing it in July here. So we're not, we're moving towards it. And remember, the goal is not rate cuts. Remember, the goal, if we're going to have rate cuts, as you can see, when yields fall, it typically falls because we are in a recessionary type environment. So that's not the goal. We don't want these cuts. We want it to be flat, just like this, for as long as possible, because that's the most bullish scenario, when the yield curve is inverted, but it's not rising, right? So remember, this was the 2019, they had this drop, and they had to cut rates because the 10-year yield was dropping. It had gone from way above the yellow and the red lines up here to falling down below the red and yellow lines. And that's when the Fed finally started to cut there in August and into the fall. There's 3 times. That's kind of what we have. It's not really. The 10-year yield's been below the red and yellow lines, which is the 3 and 6 month yields, for most of this past couple of years. And now it's kind of flirting with, at the same levels, not quite above it like the 20 and 30 year are, but it's kind of flirting with those levels, but it's starting to drop again. So, we'll see if that leads to more declines going forward from here. And again, declines, not good, right? We don't want the yield spread rising. We don't want, see, the yield spread rose here with the good way, right? This is the good way of yield spreads rising. We had a very strong 2021. We don't, with the yield spread rising, we don't want the yield spread rising because of this. And that's, the yield spread's rising a little bit here, but we'd prefer it to come back down because the markets love that. If it starts to take off towards a 1.5%, 2.5%, because we're falling, which is kind of what the theory is, that we really want to get the Fed funds rate much lower than the 10-year, then that's usually not a good sign for risk appetite. All right, let's take a look at how the sectors performed this week and today first. So we'll take a look at June 27th and take a look at this. You can see the S&P 500 again rebounding in the late afternoon. But look at that, XLY doing very well, which will lead into our trade idea today. XLC blowing up to the upside. XLI moving higher, so very good cyclical performance. They were gaining for most of the day. Real estate was up there too early in utilities. They pulled back and never did rebound as well. Technology lagged behind, but perspective on that is technology has been killing it all week, right? So now XLC and XLY kind of caught up to where technology already was. So not too concerning, because it had been such a strong outperformer for most of the week. It's been why the markets have been as bullish as they are. And all the safety sectors all lagging behind for the week. Your other cyclical areas kind of lagging the market, which is good, right? Because remember, we want them up. We just don't want them beating the market, because that's when those are outperforming SPY, it's usually because these three are underperforming SPY, and that's usually because we're down. So they're not correlated with risk appetite when XLB and XLI and XLF are outperforming. There might be a day or two where they do, but for the most part, you can see since the April 8th low point, so starting on April the 9th, we had a good run with financials and industrials. Whoops, here, let's change that to different. There we go. And you can see communication services, discretionary, technology. Those are the areas you want to lead, right? The industrials have had a good little run, but those are the areas, especially technology, because, again, as we saw, a big chunk, 13% of the entire S&P 500, almost 14% of the entire S&P 500 are in Microsoft, NVIDIA, and Apple. And you include Broadcom and other big tech names in that list. It's a very strong, a very high percentage of the S&P is weighted in that sector, more so than some of these other sectors here. So we want it to do well, and it has been absolutely, since the markets rallied 23% off that April 8th low, technology has been absolutely killing it. And really, when you come off the April 21st low, starting on the 22nd, it's even more of an outperformance. So here's the 22nd. So coming off of that low point, you can see again, just absolutely killing the market. 1.5 times the return, getting close to 2 times actually the return of the S&P just by itself. So that's good, right? That's because we are in a market weighted environment, and that's the sector we want to lead. And as long as it continues to lead, then we're fine, right? That's, if I look at the ratio, the chart here. There we go. So I didn't want to make you wait, but here's our relative rotation graph. Look at XLK kicking butt. The energy has been doing very well. It's pulling back, which is actually a good thing. Discretionary is over here not doing so well. It's been moving up. XLC is moving up. That's on the daily chart. If I look at the weekly chart here, again, XLK moving up to the right. XLY moving up to the right. XLC had been in yellow, moving up. Everything else moving down to the left. This is classic positive risk appetite rotation right now. That's what I mean. Now, granted, before it wasn't, right? When these are all up here, this is not classic risk appetite rotation, and that's why we had our correction. Those led during the correction, but since the pullback, it's been rotating in the right direction, very much so in the right direction there. All right, now let's take a look at our trade idea of the day. It's actually one of these mega cap names, and it's one that's been lagging, Amazon. But Amazon kind of broke out today. This is, we'll take a look at the moving averages here, the 3 green arrow chart. Big time volume today, big breakout above the value area, big breakout above recent highs. MACD crossing back above its moving average. Stochastics back into bullish territory above the 60th percentile. Now let's take a look at the the market forecast chart. 4A here. You can see on the market forecast chart, we got a cluster with the intermediate line getting back into the reversal zone. That's a good sign. You like to see clusters when you're getting back into the reversal zone after, light pink shading, kind of like a bull tag type move. I mean, that's how close we were to getting a bull tag. Light pink shading a little bit after, and then the yellow line. So not quite there, but same idea, and nice, good bounce, really good bounce this week. Taking a look at the weekly version of this chart, you can see that, you know, we just got a golden cross. So coming off of this pullback where we had a death cross, we got the golden cross here, strong rising PPO. We're going to get a good candle next week. Looking really good from that perspective. If I look at the regular 3 green arrow, you saw the good strong volume, but on the day we get 3 green arrows, you get good strong volume. Very, very good sign there. The DMI and the ADX, you can see above 30 in the positive indicator, below 20 in the negative. Your ADX is already above 20 and rising. If you look at the RSI and the CCI, they're also showing very good levels, closing above 220, well above 60, well above 100, above 200 on the CCI. Looking at the Ichimoku cloud, we are way above the cloud. Rate of change is clearly positive. A mature bullish trend going on, so that's positive. And then finally, the Bollinger Bands and the Keltner channels. We are up above the upper band today. Good move. Above the upper Keltner. I mean, that's to get 3 green arrows and a strong volume and a cluster and a breakout above, you know, this and the breakout above 200 on the CCI and above 60 on the RSI. Like, these are all breakout patterns all occurring on the same exact day. Very, very good development for the stock. So let's take a look at its options, because it's very expensive stock. Well, not as expensive as it used to be, but expensive stock. Let's come down here to July expirations. It's barely still in the 20 range. And let's look at the standard deviation. Let's come here to the Bollinger Bands again and look at Amazon. So right here. The only thing is we don't have the green arrow, the green dot yet with the bands themselves crossing out of the Keltner channels, but again, we're very close. July expiration, we're looking at 240. So if I look at, you know, like the 26 delta here, sell the mid-20s delta, we'll sell the 232.5 by the 230. You can see we're getting a pretty decent reward to risk ratio. Here, let's change this out to the actual expiration date here on the 19th, and we'll zoom out to about a 2-to-1 with a lot of flexibility for timing in case it doesn't work out. So let's go ahead and right click, confirm and send, and we'll send that to our market outlook category to go through on Monday morning. All right, well, that does it for today for our free Friday preview of the market outlook. Thank you for watching. I want to hear from you now. Scroll to the bottom. There's a link right below the video that will get you to the bottom, to the comment section. Comment on the post, anything that stood out to you today. What's your market outlook? What are you thinking? You can also do that on YouTube. This video is on YouTube. You can post it, your comment down there as well. Also, tweet and embedded in the market outlook post is today's tweet. Reply to that. And let me know what you're thinking there. Let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe, like, and comment and share on the YouTube video. Follow us on Twitter and Facebook so you can stay up to date with the previews I send out during the week. Subscribe to our site for the basic subscription. You see the notification at the top. It's free. You can be able to get the preview post every day. And of course, if you want this full video every day, subscribe to our foundation level. It's only $1.40, less than $1.40 a video at $29 a month. Or if you do the yearly version at $2.99 a year, you get 2 months for free. So it's like less than $1.20 for video. So if you find these videos are worth $1.20, then subscribe and get the full version every single day for the rest of this coming year. Thanks again for watching. Have a great rest of your weekend, everybody, and we'll see you on Monday.